quite happy with it because it keeps the top side open.
Well, welcome back to the Comstock channel. I'm Marlin Bohling with you. It's a pleasure to visit with you as we put a bow on this trading week with help from Relph of Comstock Investments. He joins us now as we recap Friday's market action. Eric, as I take a quick glance over here at the grain sector, the way we closed, I can't say that was very impressive here. What do you think?
Yeah, not very impressive. I did get several calls throughout the day today trying to bargain shop some new crop corn, and maybe that'll end up being right. Contract lows in the December at 428. We finished today, hopefully above 434 because I have some stop orders there that I don't want to get hit. So we're hopefully going to find some footing in here. If there's enough bottom pickers coming into the market, we should see some kind of a turnaround. But right now, I mean, you look at the midday GFS forecast and it's wet for a big area. Unfortunately, just north of you, the whole state of Kentucky is bright red in the 10-day outlook. And they can ill afford that, so there's a mixed bag of situations going on here nationwide, but I think the way they beat up the new crop corn, it's got to be considered, especially for feed end users. If you're feeding hogs or cattle, you got to be looking at these prices and thinking, okay, I was penciling $5. I can lock up some 430, 440 type prices here. Better get some of that done.
Well, for the long range forecasters that have been tooting the horn of drought fears in the plains here this year, so far it seems like we're going to have to wait a while before any of that might come true.
It seems so. You talk to people in Nebraska, particularly a lot of regions in the Dakotas, and even in western Kansas, particularly northwestern Kansas, and it's rough, and they're powder dry. And Nebraska as a whole, if you look at the weekly drought monitor, is just a bullseye for a lot of that stuff, and so there's definite problems. Opposite of what we just talked about in Kentucky. And we knew coming into this year, if you looked at the long range forecast, that everything east of the Mississippi was going to have that wet potential and west of the Mississippi was going to have that dry potential. There is a little discrepancy between the EU and the GFS right now as to what kind of moisture levels we're going to get in the west. So it'll be interesting to see how that plays out over the next week or so. We were supposed to have an inch and a half this week here in Northwest Iowa. And so far we've had 400ths. So
interesting. Okay. Well, things can be very localized when you get into summertime weather patterns here. What do you do when it comes to trying to protect your bottom line in these markets now? You were talking about the new crop month, that you were watching that earlier. Mm-hmm. Is there kind of a favorite strategy that producers are using to maybe set a floor in there?
I wouldn't say that there's a favorite strategy necessarily. It's usually just the trader's preference. Some traders are completely adverse to futures. Others are completely adverse to options for different reasons. But it's all about what the risk tolerance is on the individual trader. And, if you're just looking to set a floor, leave the top side open, then buying puts is a great alternative. If you do think we're going to get into a weather situation moving through the growing season, the put options look a lot more attractive because you're not just completely capped as soon as you put that on. You can't lose more than the premium of the long option. So it's like I said, it varies depending on who we're talking to and particularly what areas they're in. Right now, I would say Nebraska, South Dakota, Kansas people are more interested in protecting the bottom side with leaving the top open. So they're leaning more towards the options because they could see potential for a summer rally if it continues like it is for them right now.
Do you think there's a money flow out of commodities and back into the stock market right now?
That's what it feels like right now to me, especially when you see days like this where gold's down $50, silver's down 50 cents, greens are down. The only thing that kind of rebounded today was the cattle, but that was because they've been flushed the last 2 days. And so, yeah, it just generally does feel like there's money flow coming out of commodities. And you look at the equities and heck, we're within a couple days shot of challenging all-time highs. It's got to be where the money's going.
Well, and I hear people talk once in a while about trying to put in options like on new crop months, like December corn or November soybeans, but that's a ways out. And that means there's a lot of time value involved in that option premium. But I heard you talking the other day about there are alternatives to that maybe a lot of people out there don't realize, and you call it short-dated options. Just for the benefit of those out in the audience, How does that work? What are those?
Yeah, so short dated options are available for first month new crop. So in the case of corn, you can have every month you can buy a short dated option up to October. So you can buy a short dated July, August, September. That works off of the December. So the advantage there is you're just not paying for the entire time of the December contract. So it still works off of that strike price, but you're not paying for those extra months of time if you don't want to. And so for a lot of people, it's like, well, I want to make sure I capture this report or this seasonal time frame or this potential weather adversity. And so we cater the time based off those short dated options, depending on what the trader is looking to protect against.
So explain why that would be beneficial over just buying an option in the July contract.
Because it is for the new crop production. It is based off the December board in the case of corn, November beans, obviously in the case of the soybeans. And in that, it's a true new crop position. You're just doing it without paying for all the time.
And that would come in handy in case there's a big spread change, right?
You're actually protecting your production month or your sale month, whatever, however you want to look at that. You're actually protecting that new production that's in the ground and whatever happens to it from a calendar standpoint. So it is going to be based off of that first month after harvest, which, like I said, November beans, December corn, but shaving those months of time off, which can oftentimes save, in the case of corn, you could save 10 to 20 cents on a given option. In the case of beans, it could be as much as 40 to 50 cents.
Ironically, the demand seems to still remain pretty good on corn and soybeans, doesn't it?
Quite good. It's hard to paint a real bearish picture with the data we have at hand right now, especially after that last USDA report, yet the market continues to struggle. And so it's kind of a head scratcher in a way, but the market's always forward looking. And basically right now what they're doing is they're predicting a record perfect growing season. And so I feel like that's why I'm kind of taking a step into that new crop corn, because I do feel like they are pricing for perfection. I mean, we're starting this year out with a 1.8 billion carry. Last year, we started out with a 2.2 billion carry. We're running at a lower price than we were at that time. And we have shaved that 2.2 billion down to a 1.4 right now. So, and at lower prices. So we're trading a lower value now than we were when we thought our carry was going to be over 2 billion bushel, when we're at a 1.4. And in the East, things are pretty tight. There's actually a little more surplus in the West, and that's been surprising some people, but you can see basis changes in the East that would indicate supplies are tight right now. And most would argue that pipeline supply in corn right now is somewhere between that 1.2, 1.3 range. So we're awfully close in old crop, according to current predictions. And that's without full adjustments to the exports. At least I think so. I think there could be some increases in export demand in the subsequent USDA reports before it's all said and done.
Well, we had some big volatility in the entire soy complex this past week. Can you explain to our audience why?
Yeah, to the best of my ability, I can. The details are still kind of shadowed, but what you're referring to is yesterday's limit down move in soybean oil, and you can look at the July soybean oil. We had just been straight up for a week straight, and that was because rumors were starting to circulate by early week that there was going to be some biofuel guidance that was going to be quite beneficial. The quantities were unknown, but there was suspicion as to what that number might be. And then that number was changed pretty dramatically about 30 hours ago. And you saw, well, about 48 hours ago, I guess. And you saw the limit down move in the soybean oil yesterday, then gap lower to open today. We did see a little bit of rebound intraday, still finishing lower for the day, but well off of the low. So maybe we've punished that as far as we're going to for the moment until we see some more details out of this. But at the end of the day, it's what is the SAF? What's 45Z going to look like? What's the SAF blend going to look like? Are we going to make a push for E15? All of these things are being discussed in the biofuel sector, and the market's trying to navigate its way through that. And so you saw a similar situation in the soybeans too. I mean, the July contract down a penny and a quarter today at 10.50 smooth, but that was after a huge down move yesterday. But I would bring this up. I don't know if it's going to be very visible to our viewers, but we did touch the 100-day moving average yesterday and almost got there again today. held yesterday's low at the finish and then came up off the low to close this afternoon. Not a terrible look, just not what we wanted to see after the nice little rally we had seen the preceding week.
Corn seems to be hovering around some long-term support, doesn't it?
Yes, it does. And I'm going to flip out to a long range chart here. I'm going to go to the December monthly for perspective here. These are the lows I was talking about at 428 back in November of last year, and then another 428 low in December of last year. We're getting awfully close to that. We closed today at 435.5. I think that's an acceptable risk parameter for most traders to be trying to take a step into the long side of a market, especially if you're needing to do so to cover feed needs. So I think we're going to see quite a bit of that. In the case of the July contract, not quite the same, but somewhat similar when you look at the long term. We had a low there of 421.75, currently about 22 cents above that. This is a very long-term look at this July contract. When you kind of zoom out, so to speak, you can see we didn't even come overly close to our low from Tuesday. Nice to see that hold. We'll see how next week looks to start things out.
Looking at the wheat trade, it looks like it's in never land, and this is after we had the Kansas wheat tour wrapped up. They're actually looking at some really healthy yields this year, although that's pretty debatable depending on who you talk to.
Yeah, up for debate. Maybe the grain comes off, but that's still up for debate as well. Yeah, so the Kansas wheat tour comes out with a yield of 53. That's 20% above their 5-year average of 44 bushel. That put a little pressure on things today. And that was the case kind of throughout the overnight and into the day session. It just kind of accelerated as the day went on. We end up finishing the KC down 11.75 at 516.5 in that July contract. And all of a sudden you have pulled back a 38% retracement of this low to high move over this week. We're still quite a ways off of the low, so not all hope is lost, but this market has just been battered. And there's a lot of people talking about maybe feed demand shifting rations over to wheat from corn. And I don't think most of the people who would be talking about that understand the logistics that go into that. But that chatter is out there as well, because on a cash basis in Garden City, Kansas, where I'm from, wheat is actually cheaper than corn today.
Okay, crazy times.
Yeah.
Well, according to the old saying, some would think the fat lady has sung in the cattle market. But then you have a day like today to wrap up the week, and it looks like maybe she was just warming up in the green room. How do you look at this cattle trade overall? Did it save the day at the end of the week, or what?
Well, it didn't exactly save the day. I wouldn't say that. We definitely had a tough week in the cattle after making a new high on Wednesday and then having a key reversal sharply lower by the time it was all said and done. On the weekly, we finished let's see here. $2 lower, $2.45 lower for the week. Not the end of the world. The cattle market, we know it's been super hot, and this thing needed some kind of a correction. And someone had to ask me earlier this week what it was going to take for me to be convinced that the high was in the cattle market. I think that was you that asked me that. My statement was lower weekly close combined with lower Fed cattle cash. And we got the lower weekly close, but we still had higher cash this week, despite of what the board did. Pretty remarkable stuff. The cattle market is just as hot as all get out. And, it's going to wane. We know that. We're coming into the season where that happens. Once we do have those two things combining, then maybe we've got something to talk about. But right now, you've got the June live cattle so far behind cash. I don't know that we can close the board lower next week.
I was looking at a daily chart on live cattle and on feeder cattle, and I mean, we were like really close to putting in an island top on both of them, but
Very
it
close.
managed to close that little gap, and
Yep.
technically it's not an island top.
Yep.
Man, that was a close call.
It was
And that would
really
be
cool.
extremely bearish, wouldn't it?
Yeah. I mean, from a technical standpoint, if algorithms are keyed off of certain things, and that's definitely going to be one of them. And so to avoid that was probably a little helpful, but oh my God, this thing. And the one thing I'll say about it is, and it's kind of backwards thinking, but you have so many people that are hedged up, particularly with just straight futures hedges, that they're welcoming the margin relief at this point. I mean, they're just getting so fatigued with margin calls that a down market is actually like, oh, thank God for a minute. And then they start to get concerned. So here we are.
Okay, how about hogs? They're kind of floundering in the middle here.
Yeah, for the day. But I mean, they've been super strong. We saw really nice closes yesterday. A little bit of iffy trade today, but nothing I could write home about. And the hog market's just been on fire. I have heard some direct reports from some regional guys with some, we'll say, larger growing companies, hog growing companies, that is, that have expressed concern about the number of market ready hogs that are going to be available as early as 2 weeks from now, let alone a month or 2 months from now. And they think it's something that could last all the way through August, September, October timeframe. Not really sure what the duration will be there. So even though they've been on fire and we're back up close to multi-month highs in several of these summer month hog contracts, there may be a bullish story yet for hogs, and they may be playing catch up with the cattle if these disease issues turn out to hurt this market ready supply as much as folks are worried about.
Does that complicate things on the lean hog side where so much of the ownership is Chinese now?
It does. To me, what makes the hog market so complicated, not only to trade but to even read or get information on, is just the massive consolidation that went on. I mean, you can remember well back in the late '90s when that really took off, and people were just going under everywhere. $8 pigs don't do very well, and so independent growers were just put under on massive scales, and then that just immediately consolidated the entire industry. And now it'd be like trying to get true drop values on cattle byproducts from the big four packers. I mean, they control the whole thing. We can show a lot. We know they're paying more on a dress basis for cattle than what they're getting for the beef. So the immediate rub is, well, they're losing money. But that's not taking into account what the hide and offal are worth, the blood, all the drop value that they get out of those cattle. And we can't trust that they're actually operating at a loss. And that's unfortunately the problem we've run into in the entire hog industry as well. The consolidation just has it in such tight hands that we really don't know what's going on, not well enough to be able to predict the market.
I know you do a lot of work with LRP contracts. How's that been working out this year? Are people happy with it?
Quite happy with it because it keeps the top side open. And that has been critical this year because particularly the cattle market has just been a ballistic missile. And so, if you're short futures, you're margining and margining and margining and margining all the time. Whereas, your LRP, the premium is what it is. It's like buying a put option. Like I said, with regards to grain puts earlier, if you want to protect the bottom side, by all means, protect it. If it's important to you to leave the top side open, then there's ways we can do that. And LRP gives us one of those angles in the livestock sector. So that's been very beneficial. I've had several people over the last year and a half, doing alternative strategies, things that maybe have worked pretty well historically, but we've never had this kind of market. And they're even transitioning into the LRP side for the benefit of cash flow and open top. So yeah, it's been very good.
Yeah, I know there seems to be a learning curve with that, and you've been putting on several seminars this year just talking about LRP and getting people used to the concept and everything. So I think you've done a great job with that so far, and a lot of people have really been bragging on that. I would encourage our audience, if they have any questions about it, what the heck is it, how does it work, or whatever, they can get in touch with your office and talk it over, because it might be something that has been overlooked and maybe they can take advantage of.
Absolutely.
Any of the outside markets catching your attention here as we wrap up the week?
Really, the action today didn't necessarily catch my attention. I think there's still going to be some bargain shoppers looking for a little more pullback in crude oil. I wish the gas pumps would recognize the crude oil price. Other than that, I mean, God, it's ridiculous. Crude oil is $1.50 off the 60 mark, and gas goes up 20 cents. That doesn't seem justified. But we're over $3 in Northwest Iowa consistently all over the place, and we're in the heart of ethanol industry, and every gas station around here blends a minimum of 10. A lot of them are already gone to 15. and we actually have pumps where you have a lot of alternative, products available where you can get an E20, 30, 50, 85. And everybody's pushing the envelope as far as they can with what's allowable for their vehicles right now, which with the price of crude oil, just it's a bit of a head scratcher. So that's one that I'm watching obviously closely, especially with developments with Iran still coming around the corner. We'll see how things go.
One thing I noticed earlier today, and this could come into play in farm country, a lot of irrigation motors and in the fall, dryer fans use natural gas. Did I see that correctly, where it looked like maybe it has a head and shoulders formation on it?
Yeah, actually, depending on which contract you're looking at, but yeah, that does exist out in the natural gas market, and it's been amazing how strong that has been of late, and so corrective action probably due here for a little while as we increase demand moving forward here, especially for irrigation, especially if Nebraska and Kansas remain dry. It'll be interesting to see how that plays out, because that alone could reverse that market seasonally at a time when demand should be picking up.
All right. Well, Eric, we covered a lot of ground today. Thank you so much for the time. You have a good weekend out there. Eric Relph of Comstock Investments with us. That'll do it for this episode. Thanks again for tuning in. Appreciate that so much. For producer Breanne Jenkins, I'm Marlin Bohling. Catch you next time on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.